In India, physical gold is considered wealth and has a significant cultural value attached to it. But over the years, our definition of wealth is changing. Does gold hold the same investment value as it used to? What role does gold play in your investment portfolio? In this video, let us find out whether gold lost its sheen or continued to be a strong contender among other financial and digital assets. Welcome to holisticinvestment.in. Today, gold is seen as an investment beyond just buying ornaments or jewelry. The scope has widened. Investors consider investing in gold for three primary reasons: portfolio diversification, inverse correlation between equity and gold, and finally hedge against inflation. In this video, let us discuss the performance of gold in the long run, compare its returns with equity mutual fund, and how much allocation is required in your portfolio. First, performance of gold. Historically, gold has given positive returns in the long term, considering both good and bad times. The price of gold in a short term period would be in a fluctuating trend all through the years, but it has served as a safe haven for investor. You can see the graph here. From the year 2003 to 2022, the gold price is in a rising trend in the long run. Now, let us look at an example from the past record to understand gold's volatility better. The graph here shows the annual return for the calendar year since 1991. In these 30 years, the average return is 9.8%. It has also given a negative return 7 times. From the record, it is evident gold has been able to give an inflation meeting return. This is one of the reasons why investors consider gold to be a safe asset. First, we looked into the price trend, then the annual return of gold. But as an investor, we may need to look into the compounded annual growth rate for various periods. The table here shows the CAGR for both short and long term period for gold. During the last 2-year period, it has given a negative return. In the longer time frame, CAGR is more or less the same. The 15-year period and the 20-year period CAGR is more or less the same. Now, to have a better understanding, we can assume investing a certain amount in lump sum or SIP mode in gold and get ready for some number crunching. First, lump sum investment. Let us assume 1 lakh is invested in gold. Similarly, the same amount of rupees 1 lakh is invested in equity mutual fund on the same date. For illustration purpose, we have chosen Kotak Blue Chip Fund. The table here gives you the return in terms of value and in terms of percentage for gold and equity mutual fund. The CAGR is for the investment under various time period ending as on 31st August 2022. The 20-year CAGR for gold works out to be 10.91%, which is an inflation meeting return. Comparatively, the return on equity mutual fund scheme is on the higher side, which is 19.18%. One more important point to be noted here is there was a dip in the return in the 10-year gold return. This shows the volatility of gold. It also demonstrates the risk in gold investment. Now, let us calculate the figures for SIP investment. If someone does a regular investment in gold like the one we do in mutual fund scheme, then the value of monthly investment of rupees 10,000 is given in the table. For comparison, a similar amount is invested in equity mutual fund scheme. Here, SIP helps to achieve the rupee cost averaging strategy. So, when we analyze the return of gold under various time period, it hovers around 7% to 9%. Again, as seen in lump sum investment, the returns are inflation meeting. Comparatively, in the long run, however, equity mutual fund proves to be a better alternative, as it can deliver you decent return ranging from 12% to 15%. This can be considered inflation beating return compared to the returns we get by investing in gold. Here comes the golden question. Why one should hold gold in their portfolio? Let us look at some of the reasons for the question why. Gold acts as a safety net for investor at times of financial distress. You can either sell or pledge it in order to use its proceeds. Gold is highly liquid asset. Generally, it takes 2 to 3 business days to encash any other financial assets. But that is not the case with gold. Unlike stocks and cryptocurrencies, there is no specialized knowledge required to buy gold. Also, tracking the performance of your investment is mandatory in case of equity-related investment, whereas gold is considered as a traditional investment vehicle. Indian investors prefer tangible assets to digital assets. Real estate comes in first place in tangible assets and gold comes next in line. Due to inverse correlation between gold and equity, it reduces the risk in your portfolio. Gold reduces the volatility in a portfolio. The above figures and graphs clearly depict that return on gold is definitely an inflation meeting return. Gold is also considered as a sign of wealth in India. Indians cherish wearing gold jewelry. Some investors try to accumulate gold over a period just to gift their children with gold jewelry on their occasion of their marriage. You can invest in gold for safety, liquidity, and as an easy asset to stay invested in. But if you are looking for a way to accumulate wealth, gold will be of little help in your investment portfolio as it will not help to create wealth. You can avoid owning gold for wealth accumulation. Next, we shall move into another interesting question. How much gold do you need to allocate in your portfolio? Investing in gold can be inevitable for Indians, especially in physical form or paper form. There is a plethora of options available to invest in gold, including gold coins, gold ETF, gold bond. The percentage allocation of gold in your portfolio depends on your financial goals and risk appetite. It would be beneficial only if you plan to hold your investment in gold for the long time. Having 5% to 10% of assets in gold will ensure the safety of your portfolio. The range of 5% to 10% might seem larger. The reason for that is that in the last segment we pointed out that some may want to hold gold to show off their wealth or present it to their children. For those investors, the higher side of allocation will work. An investor who considers gold as an investment diversification can stick to the lower range, that is around 5%. We would like to conclude that gold as an investment is a safe asset, but it will not give you any return on a regular basis. As a tangible asset, the return will be in the form of capital appreciation. So you can limit investing in gold to 5% to 10% depending on your individual need. For investment purposes, paper gold will be a better fit in the long run. If you are looking for better investment avenues, you can choose to invest in equity. As it earns better returns in the long run, it is tax efficient, it also has a better compounding effect. You can pack your portfolio with investments in equity to generate inflation beating returns, as gold only delivers you returns that meet inflation but not beyond it. This investment strategy will help you to accumulate wealth in the long run. A detailed blog post in this topic, gold's role in your portfolio as an asset class, is available in our website. The link is in the description box. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.